Hello, this is Andy Barcade, and I'm the publisher of the Think to Retire newsletter and AIA. And this is our monthly webinar for the month of March. So let me just kind of move myself up to the top of the page, start the webinar. There we go. I'll be up here in the top right-hand corner from here on out. March 26th today. This is our month in review webinar. So let me go ahead and get started in the interest of time. There we go. Now, I guess, first of all, I want to mention I'm not going to be taking live questions during the webinar. I never do, but I want to make sure that your questions get answered. It's important for us to communicate with you, and you feel comfortable that you can communicate with us. There's my phone number. You see that there. I'll have the slide at the end of the webinar also, so you can write that down if you don't already have it. There's my direct email. Our website, where you can go on there, and there's links in multiple places where you can request a phone or a live demo to actually talk to us and go through the system again. We want to make sure you know how to use it the best it can be used, so you understand you can actually deploy it and have it work real well for you. And again, the webinars we have here are all archived on the website. This one will probably be there in a day or so, but just kind of look out for that if you want to hear it again. Okay. This is what the market's done over the past month in March. Now, this is not all March. This little end here is March. This big dip is COVID. I just like to put on there to give us some relativity of where we've come from and where we've gone to. The market this month has gone up about 3.65%, and the Treasury bill is still a relatively high 1.72. Literally, just maybe 4 or 5 weeks ago, we were about 1%. That's a big move in bonds, and that's part of what's got the market nervous. Now, some of the current market drivers, interest rates going up. That's what's got a lot of folks' attention. This big COVID bill that's passing, $1.9 trillion, which the market likes all this new money going out. Not sure how we're going to pay for it, but nonetheless, it likes the fact that money is going to slowly get out of the economy, which will get into people's pockets, will in turn more than likely drive stock prices and earnings, which is why you see it moving today. Vaccines are coming out. They're going in people's arms. The reopening of the economy looks a little bit more like it's coming around the corner. Partly because of these vaccines, the market is somewhat pricing that in. Price of oil has gone down. Actually, it's gone up a little bit first, but this last month has kind of come down a bit. And there's concerns about higher taxes, and the odds are we'll probably get some tax legislation, or the attempt to have some tax legislation sometime, maybe the late second quarter, third quarter of the year. We'll see. Okay, this is where we're at currently, the current allocations and the sector rotation. We are currently split across the board, 25% across the board in technology, energy, consumer non-cyclicals, and industrials. And again, you can see the symbols, you can see the mutual fund as well as the ETF symbols. These were all holdovers from last month. So if you remember last month, we didn't have any changes. They stayed the same. That happens pretty regularly, where the strong sectors one month continue to be the strongest sectors the next month. Doesn't always work that way. Sometimes there's a few changes, sometimes there's none. So now, to kind of give you a little bit of a heads up, this is what might happen here in a few days. I believe the 1st of April, I believe, is Thursday. So you'll have another newsletter bright and early on Thursday morning, so I'll be looking in your inboxes. These might be a couple of the changes. Financials might replace consumer non-cyclicals, and basic materials might replace technology. That's kind of the way it's looking now, but Dan, don't make any moves yet. I'm just trying to give you a heads up. Okay, now, again, this next segment is, I like to go through the idea of our newsletter, the idea of adaptive investment allocation for people that are a little new to the newsletter, maybe new subscribers, maybe you just want to hear it again. I think it's good to hear it often so you get reminded of what we're doing, why we're doing it. So we're a newsletter, a digitally delivered newsletter to our subscribers. It's a private newsletter to subscribers only. We send you out a weekly market and review, comes out every Monday morning in your inbox. If you're not getting it, give us a call because you probably don't have your correct email address. You get this monthly webinar, which we do at the end of the month, actually the 4th. I usually say it was the last Friday of the month, but sometimes we have a holiday on Friday. Sometimes I'm out of town. It'll be the last week of the month, and you'll be notified via email what day that is so you can tune in. It's also going to be archived as well, as I mentioned earlier. In a lot of cases, we're going to send with the newsletter, which comes out the first trading day, the first business day of every month. We're going to probably put a little bit of additional financial information that we think is important, maybe something about taxes, Social Security, Medicare, estate planning, just to kind of keep you more well-rounded in what's happening out there financially, so you can see what the world is throwing at us and hopefully make some changes to make your financial situation better. But the main meat of our newsletter is AIA. Let's talk about that. It's really sector rotation, trying to be in the strongest parts of the market on an ongoing basis, and actually having risk management on top of it. So if the market's falling, it looks like it's going to continue, even good sectors, even good stocks go the wrong direction. We want to be away from those. We want to back out. We want to gain or capture most of the market upside in the good years and avoid most of the downside in the bad years. And by doing so, if we can reduce the volatility, the rate of returns will take care of themselves over the long run. And again, you can see videos on AIA, which will probably be a little bit more detailed than what I'm going to talk about this morning. Or you can just go online and request a demo, and we'll just have a conversation. Okay, go through it. You probably have heard of Ben Graham before, and if you've been around our newsletter for a while, you've probably seen his picture in this slide often. He was a Ivy League professor, taught finance, wrote one of the definitive books on investment management. Students are still studying it today, and he wrote it back, I believe, in the 50s. His most famous student was Warren Buffett, but he said a lot of quote-worthy things. And this is one of them. And if you understand this, you probably understand the rationale and the thought process behind Think to Retire and AIA. The essence of investment management is the management of risk, not the management of return. If you think about it, again, like I just mentioned, if you can avoid the risk, if you can avoid the downside or a lot of the downside, the gains will take care of themselves in the good years. Okay. Markets have personalities. And again, that's a funny way of saying, depending on what's driving the market, what's happening in the economy at the time, the market tends to favor certain sectors, certain asset classes, certain industries over others. And it's the goal of AIA is to present to you the top performing sectors as far as relative strength on an ongoing basis, because they do rotate. They do rotate. Now, if the market's very strong, all the sectors might be going up, but some will be going up a lot quicker than others, and some are lagging. We want to keep in the ones that are actually performing better and keep away from the ones that aren't doing so well. And also with the risk indicators, which we're going to talk about in a minute, try to keep out of danger as well, because even good sectors, even good stocks, good asset classes go the wrong direction and lose your money when the market's getting beat up. Okay. Now, again, I have to say this all the time. You want to have a brokerage account that you feel comfortable with. Again, because we don't control where your money's at AIA. We don't control what firm you use. We don't control your accounts. We don't put the transactions in for you. You do that for yourself. We don't know your passwords. We don't know how much money you have in your accounts. So again, we're trying to help you help yourself. Help you. You can do it. Actually, you can do it for yourself, but not by yourself. Is kind of one of our slogans. And we're not trying to give you individual investment advice. We're trying to help you do better on your own by supplying you the data that you can apply and do it in a very simple, easy to use, quick manner. I had a friend of mine send me a newsletter that he uses to pick individual stocks. He sent it to me to take a look at, and it was 23 pages long. And again, I don't know about you, but I'm not sure if I have the time to read 23 pages every single month. So our Think to Retire newsletter is pretty much reduced down to one page. Here are the allocations. There's where we were last month. Here's where to go this month. It shows you our risk indicators, and you can just take off and go apply it. It's something you can probably look at, go to your brokerage account and make the transactions and changes inside of 10 minutes. Okay. I've said this many times, and I believe that my whole career, I've been doing this for a living in the financial services business for 35 plus years. I think most people tend to underperform or fail or lose money, not because they don't have the intelligence or they don't have the desire. They just don't have a system. They're kind of random. They're too emotional. They don't have something to guide them that's rules-based, that's math-based. And AIA can provide that system to you. That's one of the roles that we're trying to play for our subscribers. Okay. AIA. There's about 11, 12 different individual sectors, major sectors, and during positive market conditions, where the market looks like it's strong and it's going to continue, We're going to give you the ones that are showing the best relative strength, the top 4, and you can basically make the transaction and stay in those. If we have a negative market environment by our risk indicators, and we're going to get to that in just a minute, we're going to issue an alert, go right to your inbox. So always be watching your inbox. This is going to tell you to back away and go back into bonds or some sort of cash asset to just stay out of the market, because we believe the market's going to continue going down. Now, again, the risk management indicators, we have 2. We have a short-term indicator and a long-term indicator. They both have to be positive to be in the market. They both have to be positive to be long those 4 sectors. If one of them trips off negative, we're going to issue that alert and ask you to move away from the market and stay safe, because we believe there's a storm coming, or there's a storm that's starting that may get worse. Okay. Our risk management indicators are designed to crunch data every single day and show us the probability of the market direction continue, whether it's up or down. They're looking at things like new highs versus new lows, advancing volume, declining volume, different moving averages. And the goal is to look at the market and look at and try to judge the demand or the lack thereof for stock and equities. And again, if it looks like the market's going down, let me give you an example, I guess, the best way to do it. If the market if you're in an uptrend, it starts to fall, the data points around the market have to prove or justify that this new trend, this new downtrend, looks like it has the probability of continuing as a downtrend. If it does, the indicators will trip off. We'll send you an alert to back away from the market. And on the other hand, if the market starts to go up, if we're in a downtrend and the market starts to come up, that data that they're analyzing has got to prove that this new uptrend has the probability or a high probability of continuing. And if it does, we'll issue another alert, get back in the market. So something, watch your inboxes all the time, because we communicate mainly by email. It's the fastest way to get data out to you. You should also know your risk score. We have this, it's inside of step 1 of the process on our website. You can do a risk score for yourself, just so you can get an idea of what kind of risk level you might feel comfortable with. This is one I did on myself, 57. That is probably an average risk tolerance, right around the middle. So this is kind of giving you an idea of how to use AIA. Now, depending on your risk level, your age, where you're at in your retirement, you probably don't want all your money in the stock market. So you don't want 100% of your money in AIA. You may want a portion of it. In this case, somebody moderate may have about 60% of the money in AIA, split between those 4 sectors we talked about. And maybe 40% is always in something different, bonds, cash, something out of the market, so you're less aggressive. Now, this is in a positive market environment. We'd be maybe split 40% in bonds, 60% in AIA if we're moderate as far as risk. And if we have a negative market environment, if one of the risk indicators flips and we send you out the alert, you'd move out of AIA, so you'd pretty much all be in bonds away from the market, trying to hide and ride out the storm. If you're a little bit more growth oriented, you may use it differently. It depends on what makes you feel comfortable. This is a bit more growth oriented. Maybe you have 80%, 90% of your money in AIA split between the 4 different sectors, and 10, 20% of your money in bonds, just to be a little safer. That's in a positive market environment. If we go negative, the indicators trip off, we'd be back in bonds just to miss that downside. Okay, this gives you some of the return information. I think it's important to understand this too. This is AIA moderate, which lines up to that 60-40 split that I mentioned a minute ago. 60% in AIA, 40% in bonds. That's what this is showing you here. This goes from 2001 to the end of 2020. The top line, the blue line, is the AIA moderate model 60-40, and the bottom line is the S&P 500. Now you can see just from a rate of return over that roughly 19-year period, the rate of the S&P was up about 7%, and the moderate model was up over 12.6. Big difference in rate of return. 100,000 grew to about 377 versus over $1 million in our model. But I think the more important thing is looking at the risk tolerance, the risk parameters of our model. Now, if you look down here to the loss exposure profile, you'll see 2 shaded areas. There's a little blue shaded area up here on the top and a darker shaded area. The darker shaded area indicates the dip the market took in 2 different periods of time. Now, this period of time was back during the dot-com bust in 9/11. This dip, this volatility was back during the mortgage crisis, 2007 and 8, 9, right in that range. Now you can see the volatility control that our index, that our model provided by using the risk management indicators. We didn't ride the market up and down nearly as much. And again, we're trying to reduce the gains, reduce the losses in the bad years and grab most of the gains in the good years. And if you can do that, this is some evidence that it works out better over the long run. Now, this dip this was a mortgage meltdown. That dip was over 50%. This was the dot-com bust of 9/11. That dip was right around 40%. And as you can see, you missed most of that dip here. Just to kind of make a bigger point, the maximum drawdown. Now, drawdown is defined as from peak to trough, from the top to the bottom, how bad did it get? What was the worst it got in that period of time? With the moderate model, about 10%. And that was back in the middle of 2010, right around in here. And with the S&P 500, the market, it was down over 55% right here with the mortgage meltdown we had back in 07, 8. So again, you're reducing volatility quite a bit, and still that helps those gains continue to produce at a bigger, I guess, at a more effective pace. If you think about it, this dip here, which is kind of hard to see it, that was down about, like you say, 55% from top to bottom. And because the risk indicators tripped off, we were out of the market for the lion's share of that dip. Hence, we didn't go down 50%. So we didn't have to make back up 50% to actually go positive again. So the fact that you're avoiding the downside is a very big deal, or avoiding a large portion of downside, I should say. Now, this is the growth side of it. I showed you that 60-40 split. This is a 90-10 split, just to kind of give you something to be a little more relevant with. You still have the same risk parameters here, but you see it's a similar line, but the rate of return is a little more because you're a little bit more growth oriented. The prior slide, the moderate model was at 12.6. The growth model was up about 14.2 roughly. The stock market, again, up about 7% on average. And you see the maximum drawdown in the AIA growth model was about 12, a little over 12.2. And again, with the S&P still 55. So we can show you some of these when we do live webinars to make you a little bit more familiar with them. Some of these are on the website. But again, is this going to happen again in the next 20 years? I don't know. I mean, I don't know if it's going to replicate itself. You know, the old adages, past gains, past benefits and gains don't guarantee future gains. We know that. So, but the point is, we're trying to have this system in place to allow you to have more of the market's growth in your corner and be out of the market when things look bad. And you don't want to ride it up and ride it down. Okay, almost to the end here. Again, this is a way to communicate with us. If you've got questions, I imagine a lot of you do. I've already seen a couple emails come in during the webinar, so we'll get back to you as soon as I can. But again, there's my email, there's the phone number. There's our website where you can do the demos, or ask for the demos and schedule phone appointments where we can talk one-on-one. And this website, excuse me, the webinar is going to be up on the website here just in a day or so. So if you want to listen to it again, you're more than welcome to do that. And you can also listen to some of the past webinars as well. So again, thanks. Appreciate you being our subscribers. We'll be back to you in a couple of days with a new newsletter. So watch that, watch your inbox. And again, it's Friday, so the weekend's almost over. So enjoy the weekend and talk to you soon.